Recessions aren't new. We've been through them before, and we're going to go through them again. It's actually not important what causes a recession as much as how they get us out of a recession.
Yeah, I think what we want to discuss today is not whether we're in one or going to be in one, even though obviously we're going to be touching on that. But more importantly, if you go back in history and take a look at what caused a recession or a depression, because we're going to start there, but also what the Fed's responsibility and what they did after that, and then of course what the policies were, and I think that's really important. So that'll kind of lead us to where we are today.
Yeah, absolutely. We're going to do a little history lesson, and I think some of this is very, very interesting. So we're going to start with the Great Depression, because this was really the biggest financial downturn since the Fed was created in 1913. This was the first time they had to respond to anything. So the stock market crashed in 1929. The Dow Jones fell nearly 90%.
Yeah, by the way, guys, as Danille touched on the fact that the Fed was created in 1913, guess what else was created in 1913? The IRS. Mm-hmm. So isn't that interesting? So the IRS was created in February of 1913, and the Fed was created in December. And so in 1 year, the IRS provided the government a spending, a way to spending through income tax, and also at the same time, the Fed was created, which enabled them to expand or contract the money supply as we know now. But I thought it was a very interesting year, and this was their first challenge.
Yeah, this was their first challenge.
All the way to depression.
It went all the and we're going to talk about why that happened, actually. Yep. So the Dow Jones fell nearly 90%. Imagine that. From the peak right now, if the stock market fell 90%, people would freak out. So in that... we have a little dog situation.
Yes, okay. Let's put the dog away. Oh,
so in that, we had 9,000 banks failed during the 1930s, and families lost savings overnight because their deposits weren't insured yet. So you had a crap storm going on because we had never been through a downturn before, and nobody knew what they were doing.
Now, we haven't been through a depression again since then, and a lot of people talk about this 100 years ago, so most of us are obviously weren't around. Maybe you heard about it. But what's really probably the best thing to say is a recession is pretty much months, where depression is mostly years. And so some people say the recession is like a cold, and a depression is like the flu.
You got that straight off ChatGPT.
I did. How'd you like that?
Go ahead.
Well, no, you rattled me now. But the point is, obviously, the interesting thing to go back to from the Great Depression is what happened is the Fed, they raised rates early during the downturn, and I think that was one of the things that they did. Now, keep in mind, they'd only been around for 15 years at this point.
Yeah, so basically, when you had the banks failing and the credit was gone, everybody stopped buying things, right? And you had deflation. So that was the first time you had deflation, right? Now we have inflation, but the inverse of that is the deflation. And with that, the average family's income dropped 40%. So the price of things, sure, it went down, but the average income for families went down 40% as well. Industrial production went down 50%. So it was a total mess. And a lot of that is because the Fed did not respond with lower rates. They responded with higher rates, and they realized that that was a huge, huge mistake.
So the common theme you're going to see here is unemployment. So unemployment went up, obviously, 20 to 25%. Horrible. Mm-hmm. And that created these new policies by the government, like the New Deal and things like that, to put people to work. Now, obviously, we're nowhere near that.
Well, let's touch on that. I mean, you kind of glossed over that. So that's how we got out of the Great Depression, right? We got out of the Great Depression by the New Deal, which was government programs giving a bunch of people jobs, and also World War II, because we needed all the production for the war here in the U.S. So those two things are what got us out. So the Fed did not get us out of the Great Depression. Right. They screwed it up royally, and the policies of the president had to get us out of the Great Depression.
And guys, like the things that you guys enjoy today, a lot of that was created during that period. So think of highways and freeways and dams like Hoover Dam. Like those are all things. They were infrastructure projects, and arguably we haven't really done much since then. So as you guys know, we have an aging infrastructure.
Yeah. And so, the unemployment hit 25%, stocks went down 90% from the high. Average family income dropped by 40%. That's a straight depression. Okay. So that's a little bit different than a recession. So the next recession didn't come until 1973.
Right.
So we had a good run of no recessions, no depressions, but we were a little bit more ready and prepared for this one.
Yeah, and there's a lot of things that happened, as you guys probably know. We had the Nixon broke us off of the Bretton Woods in the 70s, 71, I think it was. And then we had the war. We had the Vietnam War, right? And as you guys probably know, the war does create a mechanism for funding, right? And so, but it also creates bubbles, which is exactly kind of what happened. But what the stagflation in the early 70s is actually blamed on is the oil shock, oddly enough.
Mm-hmm.
Right?
Absolutely.
Right?
Yep. So it was oil prices quadrupled in 1973 from $3 to $12 a barrel. This means that prices of energy spiked for businesses and households.
Right. So what's happened during this period of time is that the Fed, what they did is they kept rates low during that period of time. And as you guys know, once again, looks like we're heading that direction where as the Fed keeps rates low, it creates bubbles.
That's not that they didn't do that for that one.
In the 60s to finance
in the 60s
to finance the Vietnam War, right?
Yeah.
So
basically, inflation peaked at 13.5% in the 80s. Unemployment rose above 9%, and mortgage rates went to 18 to 20% by 1981. And the stock market was flat.
So let's take a look at this chart here that everybody has up, because I think that's a really interesting thing. So when they kept rates low during the 60s, you can kind of see that. And then you can see as they got further and further up, that was financing the Vietnam War. And then the gray area is the recession. And I think what the point of the chart here is to show you guys what's happening with the federal funds rate. As rates are low, it creates bubbles, and then it rises, and then it pops. And so that gray area, those gray areas right there are recessions, and that we're going to be focusing on the gray area. But what I really want you to look at here is how the blue line spikes straight down. That's what's most important here. So take a look at 1970, it goes straight down. Take a look at 1974, it goes straight down. Take a look at 1980. Take a look at in the early 80s, and then obviously it kind of peaks down to under 10%. But these are interest rates, guys, and so every single Fed chair did something a little bit different. It's really, really important because you see, especially prior to 1980, we obviously had a lot more recessions from the early 60s up through 1980.
Yeah, and so Paul Volcker, this is the one that Powell was claimed to be, following, right? Because he raised interest rates aggressively. He let unemployment rise to 9%. He, basically, paved the way for restoring this recession through pain, right? And so in the 80s was a very painful time for people during this recession. But at the end of the day, Powell seemed like he was going to do this, but now, he's starting to lower rates. So it looks like maybe he's not going to be as aggressive as Volcker was.
But let's take a look at what really happened during that period of time. You had inflation peaked at 13.5%. So you guys, a lot of you went through the 9.1% that we had back in 2022, I think it was. So significantly higher, right? And then the unemployment went up to 9% again. So we're starting to see a recurring theme around unemployment. We saw that obviously in most of the recessions. You start to see the pullback. So what does that mean? What that means is that there's going to be obviously more people for less jobs. Okay, so that's not good for wage growth. That's good for the employer, not good for the employee. And then during that period of time, mortgage rates went up. And I remember this was back in the 80s. Rates were 15, 16, 18%, and just unfathomable if you guys think about that. Imagine that. Talk about car loans, whatever it is. Those are the rates that people were borrowing at. And so Volcker specifically did that to slow things down. And guess what? It worked. during that period.
Yep.
Right?
Absolutely. So then you go to the dot-com bust of 2001. And this was all around tech, actually. So everyone was thinking every www dot whatever was going to be worth a lot of money.
And take a look at that, guys. See, again, look at the recession and then look at the rate drop. Obviously, rates were still low in the 6.5%, all the way down to about 1%. And what you guys have all been experiencing, I think most people are having a hangover right now with rates. If you go all the way to the far right of the chart, you're thinking 5, 6%, 7% is high. Now, just take a look at what that rate is for the whole period of time. And as I'm telling you guys, I started in this business. I was doing deals in the 90s, and of course in the 2000s. And look where the rates are. They were higher than they are now. And so a lot of people that jumped into the business now, they believe that these rates are astronomically high. But if you take a look at history, they're really not. But I do remember the .com. I remember there was like X's and O's or whatever. And they said that the whole internet was going to shut down and the electrical grid and all this stuff. You guys should check this out. What was that, 2000, wasn't it?
Yeah, it was Y2K.
Y2K, they called it. Yeah. It was hysterical. I actually went over to my neighbor's house and flipped all the breakers off on his house because he was kind of this conspiracy theorist. And he came out with a gun. Like, I couldn't believe that. And I'm like, Jim, I was just messing around with you. And his wife put him up to it. But so anyway, the reality is this was a tech bubble, right? And as Danille said here, the people were right. It was too early, right?
Yeah, everyone thought that, just had a lot of money riding on all of these internet websites. Unemployment rose from 4% to 6.3%. Retirement accounts and tech portfolios were devastated because a lot of the retirement accounts were betting so heavy on tech.
Yeah, and by the way, the NASDAQ dropped by 78% during this period of time in 3 years. So a lot, this is back to that paper assets. Again, cheap money. What it does, cheap money fuels asset prices. So when there's cheap money, it goes into real estate, it goes into stocks, it goes into speculation type things. That's what happens each and every time. So it's really important to see as we're starting to come into just the one rate cut, and we have a president that wants more. There is another effect to it. So that's what we're trying to point out here.
Yeah. So basically, interest rates were 6.5% in 2000. They got to 1% by 2003. So that obviously is going to trigger us into the Great Recession, because if you have 1% interest rates in 2003, then you're going to have home prices increase. We also at that time had Bush saying everybody needs to get in a home. So that's when you had the subprime lending start. But you can't disregard that interest rates went from 6.5% to 1%.
Right. And so just take a look at that, guys. Look at the recession at the beginning of 2000. Just go straight up. And you'll see that the rates were at 6.5% right there. They went all the way down to 1. Now, what's really interesting is the overwhelming majority of you watching this, this is the time frame probably that you remember best, right? This 25 years. And so if you just draw a line from 2000 to 2025, and I don't know how old you are, but let's say you're in high school during this period of time, and now you're in your 40s, let's say, all you've experienced is interest rates under 6.5. So they went from 6.5 in all the way down to basically 1, and then they went up again, which at the beginning of the next recession in 2008, and then they went down to basically 0. This 0 created a massive asset bubble. And the purpose of this chart is to show you guys the Fed's response to recession. That's what this is for. Because the Fed has obviously 2 mandates. I'm sure it probably has more than that, but one is unemployment and the other is interest rates. And so these low interest rates, what they do is they create bubbles. And the bubble that started, I would call it in 2009, 2010. This is the GFC, right, which was the next issue we had, right, the Great Financial Crisis, which was kind of
the bubble didn't start in 2009.
No, it started in about 2007, 2008. That's when everything kind of popped. And from when the rates started going up, there were some policy issues during this period of time where the presidents were actually advocating everyone needs to own a home, right, during this period of time.
Right, and that's why. So we're moving. So kind of, what the theme here is: a recession leads to lower rates, which leads to more inflation, which leads to another recession.
Bingo.
And the only one that didn't was the Great Depression, because they didn't mess with the rates. But we went from a recession to a depression, and it was horrible. And you had deflation. But so in 2002 to 2006, because of these low interest rates, home prices surged 80% in less than a decade. Yeah. And the mantra, and we hear this, it's also the mantra in 2016 to now, is real estate always goes up. It's a safe bet because it always goes up every single year, all the time.
Right. And this is when we started to see those subprime lending and all that kind of stuff.
Yep.
As you guys know, you could fog a mirror and get a loan. They were doing those, what were they called? No doc loans, which basically means you didn't even have to say you had a job. Literally, they just basically flooded the market with cheap debt, and people got into these deals. And what really saved their bacon were the rising house prices. So if you timed it right and got out, which a lot of people didn't, because I think the number was like 6 million foreclosures, right, when it popped. Wasn't that about the number? Yep.
Yeah, and during this, home values fell nearly 30%, even 50% on some of these West Coast markets. 6 million homes foreclosed between 2007, 2014. And really what caused that was the subprime mortgages, right? It's not that house prices were too high, people couldn't afford them. It was that their mortgage payment changed drastically because it was in a bubble and people couldn't afford the new mortgage payment. Also, some people that, were getting loans had planned to just sell in the next year, because a lot of people were doing that. Buy a home for $300, sell it the next year for $330, you make 30 grand, it's great, right? And then those fell through too, and people couldn't afford to keep up with the mortgage payment.
Yeah.
So you had that. And then obviously, what did the Federal Reserve do? They cut interest rates to 0, and they also launched quantitative easing, which is when they are buying trillions of bonds and mortgages themselves, right? And so they're not putting it, people aren't wanting to buy them, so they are buying them internally. And, Trump just passed something stating that he wants the Fed to be able to do that again next year.
So, Jerry, can you go back to that chart real quick? I just want to point out something. Obviously the rates went down to basically 0 when they're along the bottom of the chart here, as a result of this big pop, right? And so what was happening during this period of time, I think, is really important. There's a lot of homes being given back to the banks, right? A lot of investors are losing lots of money. When rates go to 0, it's not good for savings rates or any of that kind of stuff, as you guys can imagine. But what I really want you to look at is how long that happened. So take a look. So this period of time, if you guys got into real estate in 08, 9, 10, and you got into real estate somewhere about 2015, 16, 17, that's almost a 10-year period that they were really, really low. And the reason that they were low during that period of time was because of the Great Financial Crisis, because of the amount of inventory that was sitting on these bank books. This was a great time to buy real estate because it was broken, it was bank owned, it was a mess, and there was a massive cleanup. And how you fix a massive cleanup is with cheap debt. Then what happened is they started to raise rates because they started to see that they needed to push back down the inflation again. So that's when you start to see these rates go up, and then COVID.
Yep. And then you had your COVID recession in 2020. This was a quick recession because it was like an instantaneous situation. But the Fed essentially acted quickly, put rates back to 0. And that's why you had the increase in the prices of homes and such high inflation that we're still dealing with now.
Right. So that leads us today. And why do we bring you through history? Because I think it's important that, one, you see the different kinds of responses. One from the Fed, which obviously completely messed up at the beginning, during the Great Depression. But after that, they started to use the expansion and contraction of the money supply, the federal funds rate, those kinds of things. They started to get a little more dialed in on those kinds of things. And each Fed policy chair has a very, very different philosophy. And we're not even going to get into the politics side of this. But, we do know that Powell's been pretty conservative up to this point because he's pretty happy with inflation. It's sitting at 2-3%, or at least 2 is the Fed's target. But right now it's just around 3, right?
Yeah, and so you have to look at from lessons from history, right? So in the 70s, inflation was sticky, and that's when you had Volcker really put the hammer down, care less about unemployment because it got up to 9%, and really focus on inflation. So Volcker didn't really focus on unemployment. He focused on the inflation numbers predominantly. And then you have to also look at what's unique today is we both have unemployment issues, once again, and inflation issues. And it's going to be up to Powell on which one he focuses on. So thus far, he has focused on inflation. But now that our unemployment is ticking up, it's still below where the Fed would want it, but it's getting right in there where they don't want it, right? Like 5% is not good. And I think it's at 4.3% right now. And so we saw a cut in interest rates. So he maybe won't put us through all that pain and maybe is going to focus more on the unemployment than the inflation.
Well, I want to talk about unemployment because I actually have some concerns around it because it's gone down since June, but I'm going to talk about that right after we get back from our sponsor here, Monetary Metals. Near all-time highs. But appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more. So with regard to unemployment, I know it went from 4.1% in June to now 4.3. Now, there's a bunch of reasons behind this. Obviously, we've got this, Trump fired the head of is it BLS, right? And they've only been there for less than 2 months. And so when we did our podcast recently with Jim Rickards, one of the things he said is when Trump goes in and they start to figure out, that they have really old models that they've based all this stuff on. Now they're going to start looking at things with new models. So what happens when you go from an old model to a new model? You start to expose flaws with the old model. And so he's predicting, and we're already starting to see this, is that this administration is going to rip the Band-Aid off of the unemployment number, and essentially they're going to try to figure out what it is today for real. Now, obviously, you guys, some of you might laugh at that, but the reality is that they're going to a new model. We're already seeing that. We're already seeing massive adjustments. But the one thing that I wanted to point out is the difference between 4.1 and 4.3 is about 400,000 people. So while it seems slight, 4.1 to 4.3 is about 400,000 people that are now in the unemployed category. That's a big number. So these little 1%, that's based on 168 million people at 0.01. And so these are fairly big numbers. So the unemployment is something that I think you need to watch, especially as inflation starts to hit employers, especially as we start to see AI rolling out and kind of, I guess, commoditizing some of these lower pay positions. Think of graphic artists and content writers and paralegals and things like that we're starting to see. Even lawyers, are freaking out because you can do things very differently than you could before. So that is also starting to make its way in, right?
Yeah, absolutely. So you have all of that going on.
Plus, you had the Fed tightening and the debt overhang. Let's don't forget about the debt. So right now, I guess the government debt's past $35 trillion with a T, right? And the interest payments alone are $1 trillion a year, right? Mm-hmm. Right. So what else do you want to cover?
Well, I would say that we should let people know what they should be doing right now.
All right, let's do that.
Okay. So if you're a worker, you should not expect a big raise right now. And it's interesting because back in the day, you would build good relationships and stay with companies a long time. Where the last few years, people are very not relationship focused. So they're just bouncing from job to job to job. And now is not a great time to do that because there's not a lot of work out there. And you actually have to, build relationships within your company.
Yeah. And I think that as unemployment ticks up, guys, just trust me, you're going to want to make sure that you're not, you don't think there's something beyond that horizon, right? We're starting to see a pullback in tech. Manufacturing is proving to be much, much more difficult to bring here. That's if you switch industry entirely. The other thing is on the home buying. I would expect that you're going to start to see rates come down. I mean, Trump, we already know he wants it to come down almost 3%. That's going to be a window. And that's why we wanted to go through history with you. There's a window here. And as rates come down, there'll be a window. I don't know how long it'll be, 3, 4, 5 years before we start to see these asset bubbles again, even though we have high price housing right now. The one thing the one good thing is that as rates come down, it's going to unlock all that trapped equity that's sitting right now. And I think last we looked, it was like $12 trillion of trapped equity in people's houses because they're staying in their houses longer because, but the one thing that we haven't really seen is a big adjustment in the home prices because inventory historically is still above the mean. So now in some areas we're seeing a lot, right? Obviously like Florida, you're starting to see a lot of inventory and price adjustments, but that's not indicative of the rest of the country, right? And then investors, just need to focus on cash flow again. So now you're going to start to see, because our deals are tough to find right now, and specifically because of the interest rates, right? Interest rates make or break a deal right now because operating costs are higher and rents are flat. You have to, if you're not budgeting flat rents in the next couple of years, you're crazy because there's a lot of choices that people have right now. And as inventory starts to get more and more and more, the big game changer is going to be interest rates because a lower mortgage payment means that you're going to have a little bit more cash flow, right? So I think you're going to see that in the short term as well.
Yeah. And key takeaways, I think, for today are that the way that governments get out of recessions is by lowering rates and increasing spending. And this cure often leads to the next bubble. And that's why everything kind of keeps going up. Because if they don't intervene and they let things fall, then you have the potential of a Great Depression style issue where you're going to have deflation, and deflation hurts people way more than inflation because you have to remember the price of things just don't go down. The price of your income also goes down. So it's not like, oh, I still make, 70 grand. Everything's just cheaper. No, now you make, 40 grand. So everything gets more expensive. So inflation is generally better than deflation.
Yeah. And then as unemployment goes up, this obviously from a common sense standpoint is more renters, right? Because if you don't have a job, it's hard to get a mortgage. I'm not saying you can't. I'm not saying you have the cash. But as unemployment potentially ticks up, it's something to watch because it's going to move people or keep people, I should say, probably in that renter category. Also not healthy. As you guys know, we need a good balance between home ownership and the rental side of the house. And right now, There's such a big difference between the mortgage payment and the rent payment. It's incredible. Partially because rents are being disrupted with the additional supply that started when rates were lower, but also partially because the interest rates are keeping people back in their houses, and so there's a lack of inventory. So the home prices are kind of staying, firm. For the most part, and so the delta between a mortgage payment and a rent payment has never been this big.
Yeah, and remember, don't be afraid to, when everyone's afraid to invest, a lot of times that's the best time to invest. So if you can make a deal cash flow, it's a buyer's market right now. You have a lot of leverage right now as a buyer in a lot of deals. And as Packet Watch said on YouTube, homes eventually, the average home will eventually be over $1 million. Like, I know that sounds crazy. I know you're looking at me like, what? No, never. I mean, eventually your average home is going to be over $1 million. Right now it's in the 400 and some thousands.
Well, we looked at Canada, guys, and I know, obviously just our neighbor to the north, their average is in the sevens.
Yep.
So, it can happen. And just take a look at their trend line. Obviously it's a very different economy, very different scenarios. But, how does it get to that is really the point. And I think that, just to wrap this up, that the cure, whatever you think the cure is, right? What it does is it creates new problems. That's what a cure often does. And so the issue isn't, maybe you can benefit from it from a short term, but then it also creates other kinds of issues. It potentially could create another bubble. It could potentially create unemployment. It could potentially create inflation. And we haven't even touched about tariffs yet, now, which we really haven't seen the impact. Some people think we're not going to see any, but that is something that's hanging out there right now. And we haven't really even touched on AI. So these are all things that are happening today. And so as we start to see the cure, whatever the cure is, and what does look like is that this new president is going to really advocate for lower interest rates. Just know that there's another piece to this, and there's a window. So the window is what we're looking at. Yeah, and all we're trying to do is look at history here so that you can kind of see what the Fed does make an immediate impact, but then it also has long-term consequences.
All right, we'll see you guys next week.
All right, see you guys.